Happy New Year, everybody. We are back with another portfolio management edition explainer video. This is part, I don't know what, I think we've done 5 or 6 of these. They've been well received. The topic du jour today is how to manage market volatility. And we're going to attack this from the market side. So what is going on in financial markets, in our opinion, that's causing this. Again, we're not predictors. We don't have a crystal ball. But this current cycle is rhyming with a few others in recent history. So we'll touch on that. And then there's the behavioral component. I think investors in general need a bit of a rude awakening. They need to get more grounded in reality, because I just think, and this is a general comment, a lot of people are headed for a disaster just because their baseline, their expectations are just not anchored in financial market history and how cycles work and how financial markets work. So there's going to be probably something for everybody. I hope you get something out of this. You know, we encourage feedback both from our clients and our prospective clients. So feel free to send us a note. So there's a many different ways to manage risk and to talk about risk. Our favorite way to do that is both simple and very impactful. So when we're talking about risk, we want to understand drawdowns, right? There's standard deviation, there's Sharpe ratios, there's all these fancy terms, but the easiest to digest is drawdowns, meaning, let's say the S&P 500 is down 10%. How does my portfolio react in that type of environment? Okay. Now, the S&P is not a relevant benchmark for everybody. It might not be a relevant benchmark for you, but it provides context. So what I wanted to show here is, despite the narrative, how 2021 was a very calm year. I mean, it was one of the calmest that we can remember. And you can see that here. So the blue line is the S&P. So again, this is starting at the zero bound, meaning at the start of 1/1 of 21, the portfolio has done nothing, right? And we're only capturing the down movement. So we don't care about the upside, hence the name drawdown. We only care about downside moves in the S&P. And I want you to ignore the rest of these lines. They mean something, but they're not relevant to this conversation. So again, the blue line is the S&P 500. And you can see, as we've gone through 2021, we didn't get a 5% pullback. We had a 4% pullback here in May, but we didn't get a 5% pullback until September, end of September, early October. And then we had another near 5% pullback just before the end of the year. But all in all, this was a very serene year. And this is one of the calmest in history, but it doesn't line up with all the problems in the economy and COVID and the Fed and inflation and all that. So I just want to point this out. So this is the baseline investors are coming off of. And again, up until September, markets were basically melting straight up. So I think that amplifies what's happening now. What we're seeing is quite normal when you look at past cycles and volatility and all that, very normal. But we're coming off such a calm year. It seems more outsized. It seems more volatile than usual because our baseline is this calm, serene market. Now, for those of you that had a chance to watch my market commentary video, I'm going to jump to that really quickly here. And the noise we're seeing has a lot to do with what the Fed is doing. And it's very common when Fed action, Fed policy doesn't line up with market expectations to see some noise, especially as the Fed pivots and changes their original course. And not to go too deep in the weeds on this, but the Fed basically dismissed inflation as transitory. I don't like that word. That means maybe 6 months to you. It might mean a year to me. I don't know. But they ditched transitory. The Fed was content on letting labor markets get to full employment, meaning people are working, people are back to work. That's happened. Okay. And the Fed has been very rigid and slow to pivot away from this transitory narrative up until recently. So the latest Fed minutes, I believe it was last week, many of the Fed governors expressed a desire to speed up both the taper and the schedule and frequency of interest rate hikes. Okay, that caught investors, that caught a lot of pundits off guard because that was not consistent with what the Fed is saying. And so this has caused some choppiness in financial markets. Back to our previous taper and then hiking cycle, this occurred when the Fed pivoted and announced the taper. It occurred again when they stopped the taper. And fast forward again to, so this was 2013, as you can see here, going into 2014. So announced taper, end taper. You can see these circles highlight the noise. And then again from 2016 to 2018, which the Fed increased rates 9 times. When they started, when they ended, there's noise in all these different changes in policy. So when the Fed changes course, it could be going from tightening to easing to easing to tightening. Any change that doesn't perfectly line up with investor expectations, markets tend to throw a fit. That said, it does reset expectation. And I think we all need to get a grip here too, because, I mentioned this in a blog, or I mentioned this to someone, but I'm watching Bloomberg TV. I'm talking to prospective clients. I'm talking to clients. And so many people are just worked up over this latest bout of volatility. And okay, let's get real here, folks. The S&P, as of this recording, today is Wednesday, is down less than 1%. Okay, so I think this is a canary to a bigger problem. And I've talked about this a lot, but it just never ceases to amaze me. I mean, the last 12 years have been really good. It's been a blissful time to be an investor. There's been very few exceptions where things were difficult. It's been mainly a slow melt up. A lot of people with assets have made money. It really took talent to lose money in this environment. And I think the question has been not if markets will go up and down over this last 12 years, but how much are markets going to go up? And I've said this time and again, and it's very relevant. A bull market covers up a lot of warts. It creates a lot of geniuses. A lot of people are overconfident and they short circuit when the markets don't cooperate. And when markets pull back or they get a little volatile, people tend to freak out. And again, this is psychology and money, behavioral biases, recency bias. This is all these things baked into one. Markets move in cycles. Good markets are often followed up with difficult market environments. This cycle's been longer than most. We just wrote about how this recent bull market stacks up, and the COVID sell-off of 2020 reset the bull market schedule. It's been a very aggressive cycle on the upside. And my fear is that a lot of people are out over their skis, taking more risk than they set out to. Like this blip here wouldn't even register on a 3-year chart, on a 5-year chart. But so many people want to make these drastic changes and they want to sell things that go down and only buy things that go up. And it's like, man, they're just setting up for disappointment. And I could go on and on about this subject. I don't want to belabor the point, but a lot of people have built their lifestyle, the way they operate, the way they think about planning, the way they use debt, the way they seek risk, the way they invest with what's happened over the last decade. And if I was to generalize and sum up all of these comments, people are very obsessed about gaining a return. They have no concept of risk. They have no concept of how much risk that they're currently taking. And I'm just worried that we've been conditioned to only expect markets to go up. There's a whole generation of investors that haven't experienced pain. But there's a subset of people that think, you just ride this out, markets go up, we enjoy the gains. And then when the stuff hits the fan, we make a bunch of changes and we shun risk. Like, that's not how investing works. I think people need to be comfortable with negative outcomes. They're part of investing. It's not a symptom that the markets are broken or that things are rigged against you or that your portfolio is broken. It's part of the cost of admission. It's part of investing. The sooner you can accept that simple fact, the better investment outcomes that you're going to get. Off soapbox, I'm done with that. Okay, and then the other part of this is, so this is the ARK ETF. I don't know if you all follow Cathie Wood. She is the pioneer of this innovation movement in investing in companies that are going to change the world from an environmental standpoint, artificial intelligence, robotics, biotech, machine learning. And this space, these unicorns that are going to change our lives for the better, we're experiencing a drastic move higher in the post-COVID world as we were all hunkered down using technology more than ever. So you can see, really starting in April of 2020, this is her flagship ARK fund. Investors just experienced a parabolic move higher. I mean, almost a 3x here, which is quite common in crypto, not common in traditional markets. So this caught a lot of attention and a lot of investors piled in on the way up. Okay. To my point, the riskiest corners of the market rise the fastest. They also fall the fastest. So a lot of investors experienced this nasty whipsaw down, and folks that were invested here and here are actually upside down on this. So what I'm saying is markets move in cycles. A lot of investors performance chase into the best performing asset classes, like the ARK fund, like technology stocks. And those are the areas that are seeing the most pain now. So the folks that I'm talking to that are disgruntled, and this isn't pure clients per se, but we talk to a lot of prospective clients, but they're frustrated, and it's because they piled into EV car makers, they piled into ARC funds, they piled into fintech, and all these high flyers, SPACs that have just gotten crushed. And it's our position that you can speculate in some of these hot areas, but for your core wealth piece, you should be mindful of not only performance, but your risk exposures in the journey. Have that be your core piece. Use your satellite, your active views of the world to speculate with a smaller percentage of your wealth, and you won't experience these dramatic rises and falls. So just to recap, I'll pause. One, I think our baseline of volatility, what's normal for volatility, is distorted because the last year has been so calm. Okay, so that's the first thing. Two, changes around Fed policy. It's very normal to see some noise. That's what's happening now, okay? The last thing is you've seen pain in the best performing sectors. A lot of investors have piled into those. They're experiencing more pain. They're more prone to freak out, okay? So between those three things, and I'm not saying this all applies to you, maybe there's elements that you can take from this, but that's what I'm seeing from more of a market behavioral side. On the things that you can do now to manage this, and I'm gonna overlap a few of my comments, but pay attention to not only your performance, but how your portfolio has acted during times of stress. So yeah, you pay attention to performance, also pay attention to the journey, right? The example I use with people is if I showed you portfolio A and portfolio B, and I said, each portfolio A and B, have the same return, 8%, okay, in any given year, 8% return in each portfolio. And I asked you to pick the superior portfolio. You could not do that just by looking at the 8%. Let's say portfolio A went like this, right? Up and down, acted crazy, and you couldn't see that. And portfolio B went like this, and again, you couldn't see that. Then you would have no way of telling what portfolio is superior. But if I showed you the journey, portfolio A doing this, portfolio B doing this, it would be a no-brainer that portfolio B is superior because it's a smoother ride, less swings, less whipsaw. That's a better portfolio from a risk return standpoint. 90% of the investors I talk to, and this goes for advisors too, can't tell how much risk they're taking because they're so drunk by performance. So pay attention to how your assets move in relation to each other. And the easiest way to do that is to capture drawdown. So again, I'm back to drawdown. Easiest way to capture risk, easiest way to understand risk. What I've done is I've thrown in our balanced portfolio for 2020. And I chose 2020 because that's when we saw a steep drawdown, right? 2021 didn't really do much, so it wouldn't make my point. 2020, we had the COVID sell-off in March, end of February of 2020. So again, the green line is our balanced investment objective. And I'm not touting this from a performance standpoint or look how great Pure did. I'm just using this for context so you can use this in your own portfolio. The blue line is the S&P. The red line is the MSCI EFA, which is just a foreign international benchmark. These are all telling the same story. So when the market was down 37% in 30 days, our balanced investment objective was down 13.5%, 14%, let's call it. Okay. I want to understand as a professional investor how my asset allocation, how our clients' portfolios respond during an ultimate crisis. This gives me comfort. This shows me that our asset allocation, some of the other asset classes in which we own to mitigate risk, are doing their job. This is this doesn't feel good, but it's much better than this. A client's much more likely to stick to their long-term plan if they can see the high quality bonds, the gold, some of the other asset classes that we own are holding up during times of stress. Okay, so that's the first thing. Understand your risk exposures, understand your journey. The time to do that is today, not when something happens, not when the market takes a dive by 20%, you're over your skis in ARC funds and you go in and make a bunch of changes. That's not a framework. That's not a good portfolio management process. You're setting yourself up for failure. So do this work today. If your advisor can't do this, that's a red flag. Go find another advisor that can. And then just a couple other comments. Seeking risk when times are good and shunning it when times are bad is probably the biggest risk I see on the behavioral side for people, right? So how this manifests itself is it's easy to be a 100% equity investor when times are good. It's easy to own more equities than you usually would when times are good. Everybody likes to make money. Everyone likes to see their portfolio value, their 401k, all that go up in value. Like that's the fun part. Okay. If you feel compelled to make changes, if the last couple months have made you nervous, you're probably invested incorrectly. Okay. And investing doesn't work where you are a risk-seeking investor when times are good, but you shun risk when times are bad. Like so many people joke, oh, I want assets that go up and I don't want to lose money either. It's like, well, investing doesn't work that way. I mean, if it did, we all would pile money into the stock market, clip 10% a year. We could set our watch to it. Money market wouldn't exist. Bonds wouldn't exist. Savings accounts, CDs wouldn't exist. Banks wouldn't exist. But that's not how investing works. So build a portfolio that reflects the way that you feel about risk. You know, if you freaked out during the COVID sell-off of 2020, that's fine. But if you were a 80% stock investor, 20% bond, and you felt compelled, or you actually sold stocks in that environment, then you're not an 80-20 investor. I'm sorry. You're more like a 60-40 investor. So the most successful investors are honest about their capacity to take on risk. They build a portfolio that reflects that. It sounds simple, but it's difficult for people to implement that in practice. And if you do feel compelled to sell, that's not the worst sin in the world, but have a framework for making decisions, right? So do all the things I talked about. Build a portfolio that reflects the way that you feel about risk. If you feel compelled to make changes, have a framework for making those decisions. If you feel compelled to knee-jerk reaction sell, maybe wait a week. Maybe write down your framework for why you're going to sell, the reasons that you want to sell, okay? And go back to those later and check out your process, check out your state of mind, your emotional disposition during that, and it's going to help you make better investment decisions. Like you winging it and deciding to sell 50% of your equities because you're worried about the market is not a process. It's not a framework. And I can tell you the worst, and this is going to sound funny, the worst thing for you, for those folks that do that, is being right. That's the worst thing that could possibly happen to you. So you decide to sell a big chunk of equities, the market tanks, you're patting yourself on the back, you feel like a genius. One, that's the easy part of selling. The part people get wrong 99% of the time is when to get reinvested. Because if you're skittish now, there's always going to be a reason to be skittish. Like if I ask the average person to come up with 10 reasons on why the market could go down versus 10 reasons on why the market could go up, the reasons the market could go down would fly off their tongue. It'd be done in 30 seconds. The reason to get invested or to think positively about the markets would be much more difficult, okay? And going back to my comments, why that would be the worst thing that could happen to you, you would be prone to do it again and again and again. And as the numbers get bigger, as your portfolio grows, the stakes get higher, and the more decisions you make, the more large active decisions that you make, the more likelihood that you're going to be wrong. I've seen it time and again. So build a portfolio that reflects the way that you feel about risk. That takes some self-reflection. It takes some honesty. You know, if you don't really have a period, or if you're having trouble with this exercise, look back at spring of 2020. How did you behave during that environment? Did you sell? Like these are all good things to get that conversation going. Have a framework for managing risk. Know that making large active decisions like blowing out and selling a big chunk of your equity portfolio, one, you're invested incorrectly, and two, that's not a framework for making decisions. And then the last thing, and I'm going to be repeating myself, but check the journey. Make sure you understand how your portfolio performs during times of stress. These are all easy things that you could be doing today. If you work with an advisor, they should be doing these things for you. They should be talking about return in the context of risk. They should be talking about how your assets move in relation to each other. They should be coaching you on the behavioral side if you're prone to making emotional decisions. So I know that's a lot. I tend to get pretty excited about this stuff just because we talk to so many people. I write every week. We're very plugged in, both what's happening in financial markets, in investor behavior, and cognitive and emotional biases. You know, I feel like Pure Portfolios does more on the emotional and cognitive bias side than most investment advisors. I think we're well ahead on that. You know, I'd like to produce more content on that front to help people make better decisions, but you know, again, it's really hard to get people to think better during good market environments, just because it's tough to recreate that fear and emotion. So what I don't want to see is people having these blind spots and biases, getting crushed in a bad market environment, behaving badly, and derailing a long-term plan. So a lot of the stuff that we talk about is optimizing the things that we can control, because the time to do something is not after the stuff hits the fan. It's today. The planning starts today. So if you have any questions, know that Pure offers a free portfolio analysis tool. We'll actually assign a grade to your portfolio, which can help get you thinking clearer. And we can give you feedback on fees, risk, tax efficiency of your portfolio. Again, we're big fans of taking the low-hanging fruit and optimizing the things that we can control. So that's the lens in which we view things at Pure. So thanks for listening to my rant. I don't think I'm lacking for passion, but maybe these can be a little better coordinated. So leave a comment, leave a question for us. We're open to feedback. Thanks for tuning in. Bye-bye.